Bharat Forge, a leading auto ancillary metal forging company, has actually posted a disappointing set of numbers for the September quarter amid a tough operating environment for the global as well as domestic automobile industry. Let's do a three-point analysis of the earnings fine print and the outlook on the company. 1. What are the Q2 result highlights? Well, Bharat Forge has posted a significant year-on-year revenue decline of 25%, led by a 23% decline in volumes. Realization also declined by 2.4%. Now, the faltering domestic business was a key drag due to the slowdown in the economy and inventory correction taken by original equipment manufacturers. Now, there was a decline in the commercial vehicles, industrial as well as passenger vehicle segments as well. Now, the decline in exports revenue also was to the tune of 18% year-on-year and also impacted the financials of the company. EBITDA margin contracted 450 basis points on a year-on-year basis. Now, the contraction was due to negative operating leverage. 2. What's the outlook on the sector going forward? Well, the domestic market has been facing macro challenges on the back of a weakening macro environment, leading to subdued business for the automobile sector, including commercial vehicles and PV segments. Now, depressed market sentiments are on the account of tight liquidity, financing issues, elevated interest rates, and slowdown in the economic activities. Now, this was aggravated by the lagged impact of new axle load norms in the CV segment as well. Now, because of these factors, the management has indicated that the demand would be weak in the near term. But it also believes that long-term growth outlook remains promising thanks to a stable government with a focus on economic activities and thrust on the increasing rural income and emphasis on infrastructure and construction. Now, the upcoming BS6 emission norms are near-term driver for the company as they could induce pre-buying as well. Additionally, the government's scrappage policy should also augur well for the company. Now, international markets could continue to face slowdown due to the weak demand of Class 8 trucks. The second half of the current financial year could be weaker than the first half as well. The management, however, expects the PV segment to post strong growth in FY21. 3. What should investors do then? Well, despite a significant decline in the stock price, valuations remain at elevated levels. Bharat Forge is currently trading at 27.1 times FY21 projected consolidated earnings, and therefore we advise investors to avoid the stock until we see signs of a demand improvement.